So for the Sector 7, which is working cash management, it involves day-to-day decision regarding investment in current asset and how these assets are to be financed based on the firm needs for the adequate liquidity. Is sufficient cash on hand to meet all short-term obligations. It will affect the firm riskiness and expected rate of return, hence the value of the firm. It can significantly affect firm risk, return and share price. Okay, so it's about managing the working capital involved with the risk return trade amount of current asset and source of financing, which is the low level of current asset could lead to financial distress. High level of current asset will result in lower productivity of asset and lower profits. Working capital will affect the firm profitability and liquidity. Okay. Failure to manage current asset component effectively and efficiently, it will lead to financial problem that may force the company into technical insolvency and eventually bankrupt. There is three of the working capital policy, which is the first one is the relaxed policy, which is a low risk policy. The firm maintain a large amount of current asset coupled with liberal credit policy. Has credit liquidity and potentially low return from investment due to low productivity of current asset relative to fixed asset. Okay, so the second policy, which is the restricted policy, which is a high risk policy. The current asset is reduced to a minimum to the stringent credit policy. Lower investment in current asset enable the firm to increase investment in other productivity investment, and thus will result in higher return. Okay, so the last policy, which is the moderate policy, it was in between the relaxed and the restricted policy. It will result the moderate risk and return investment in current asset at minimal level that sacrificing liquidity requirement. Okay, so this strategy, the different working capital strategy produce different level of productivity and exposure. The firm has production and sales cycle that varies throughout the years, and therefore the firm need to maintain a certain level of current asset. Okay, so now we talk about the approach in the approach in the working capital. Okay, so the first one, which is the hedging approach, is result in moderate risk with moderate return. The firm use temporary financing to finance temporary current asset, and permanent financing to finance permanent asset, fixed asset, and permanent current asset. Financial activities should match with asset requirement, and no need for emergency fund and ideal funds are not existed. As we can see here that in the graph, the short-term financing is the total current asset is the lower because it has the moderate risk with the moderate return. Okay, so for the next approach, which is the aggressive approach, it involves more risk because it uses short-term or temporary financing to support a relative large portion of current asset. The firm would finance all fixed asset and part of permanent current asset with long-term financing. The firm will resort to short-term financing to finance the remaining permanent current asset and temporary current asset. Current ratio is low and may be equal or to less than 1. We can see that from the graph, the short-term or temporary financing is the more as it get into the permanent current asset. Okay, so the next approach, which is conservative approach, which has the lower risk compared to the other approach. It's use permanent financing to finance the majority of fixed asset. It will result the use of temporary financing only for peak requirement or when the total asset exceed the permanent financing. If it was during low requirement, the firm will invest its assets fund in marketable securities. As we can see from the graph, that the short-term temporary financing it only use the temporary current asset, and sometimes that when it only you need to use that it will go lower than the short-term refinancing. Okay, so what is the best for the best approach? Is depending on the profitability of the firm, the stability of cash flow, the liquidity of the firm asset, the management attitude toward risk, and the expected future interest rate. Okay, so that's all for the networking capital management. That's all for the Sector 7. Thank you. See you guys later.